The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague and Chook confidant, Anthony Macdonald. Anthony, how are you?
Good, it's great to have you back in the country.
Oh, thanks, mate. Good to be back. This week we're going to look at the big renovation plan at the Reserve Bank of Australia. We'll ask who really won and lost in Rupert Murdoch's giant legal battle, and we'll look ahead to the bit of data that could decide the next interest rate decision. But first, Anthony, we should start with a company that we've been following for some months here on the podcast, and that's the Star Entertainment Group, which has been a disaster zone for more than 18 months now. What's gone wrong this week? We've had some more bad news from the company.
Yeah, that's right. So, we all know the past year or two it's been all over the coals from a regulatory perspective. The board's been cleaned out, management team cleaned out, and now it turns out the operating performance in its casinos has fallen off a cliff as well. In Sydney, it reckons that its decision to stop serving free drinks in its VIP rooms has just seen punters desert the casino. While there's also the rising interest rates and cost of living sort of crisis that's keeping away your everyday punters. But I thought it was particularly interesting what they're saying about the free drinks. I'm not sure if you've been up to the VIP sort of areas, but I remember when I was a young reporter on Street Talk, a banker taking me up there just to sort of give me a look.
Right.
And it was a weird sort of clubby vibe. You go up through corridors and up escalators and secret handshakes and doors and whatnot. And you sort of end up in this room that's got, it feels like the casino. There's still carpet on the floor and gaming tables, but, they do give you free drinks. And, Star reckons that their customers like going to this sort of exclusive room and getting drinks. And it's, I thought it was pretty underwhelming up there, though, to be honest, James.
It's interesting you mentioned that, Anthony. I wonder if there's another issue in Sydney as well as the free drinks. I wonder if the drinks are still flowing over at Crown, perhaps, where their casino's sort of the new entrant in the market, still pretty shiny and exciting toy. That's got to be having a bit of an effect too, doesn't it?
Oh, absolutely. Yeah, if you were cashed up and looking for somewhere to take your friends and impress them and you're a VIP, get VIP treatment, surely you're going across the road to the new joint.
I wanted to check in also, Anthony, about another company we've been watching closely. That's Bank of Queensland. Now, we mentioned last Friday that the former chair, who's now the CEO, Patrick Allaway, had cleared the decks with some big write-downs. And on Thursday, we got the bank's first half results. Did we fill in any of the blanks that we had around why the bank suddenly worried about risk, for example, Anthony?
Yeah, we sure did. The CEO, Patrick Allaway, confirmed for the first time on Thursday that the bank faced concerns around complying with counter-terrorism financing and money laundering laws, as well as sort of more regular prudential issues, which takes Bank of Queensland down that CBA Westpac path from a couple of years ago in terms of dealing with potentially dealing with AUSTRAC and fines and whatnot. But, that was the big news from the result yesterday. And that's also the piece that was missing from last week's statement when they came out with some of their numbers ahead of the results.
Yep.
And it answered some questions. I'm not sure why it couldn't have just been confirmed last week. I don't know if something changed in the past week or what. But, it was the big news. It's funny how it sort of mirrors Star a little bit in that you got regulatory issues, you got softening sort of underlying business as well. What did you make of the result?
Yeah, I think you've hit on a few interesting points there. One is that it's a bit like what CBA and ANZ went through a few years ago, and so you can come through it, but what CBA and Westpac had and Bank of Queensland doesn't have is lots of scale. And so CBA and Westpac were able to make the investments, able to sort of ride out this period of pain because they had the scale and size to do that. Bank of Queensland isn't in that position. And to that point, I thought it was very interesting. You look at the loan growth. I think through their own channel, their main channel, Bank of Queensland channel, 12 months ago, they did, in the first half, they did 1.2 billion of new loans. I think in the first half of this year, it went backwards, the size of their loan growth, or it was flat. And fair enough, Alloway has been saying that competition in the mortgage market's crazy and he wants to pull back from that. But you just wonder what the long-term outlook is. You're not really growing on the revenue side. You've got all these cost issues with the risk stuff. Not a pretty picture for investors, is it?
Yeah, I asked Alloway yesterday. I mean, I said to him, sell me the long-term story. I mean, why are investors going to be here in 5 years' time? What's Bank of Queensland look like? And it's a small sort of strategy, right? It's targeting the niche segments, niche products. It's not about competing with the really big guys. So it's going to be a really interesting test to see whether that can work.
Yeah, absolutely. Well, Anthony, let's move from a small bank to a very big and important one. And our first topic of the week concerns the review of the Reserve Bank of Australia. Now, this review was delivered by Treasurer Jim Chalmers on Thursday. There's, I think, 51 recommendations, the most important of which is a plan to split the current RBA board, which is made up of currently people drawn from a range of business-related backgrounds and from around different parts of the country. And instead, what they want to do now is have two boards. The first would be a governance board, which would be in charge of overseeing the way the RBA runs itself. Fair enough. The second board would be the one that decides where interest rates are going. And it would include the RBA governor, the RBA deputy governor, the Federal Treasury Secretary, and then 6 experts who are likely drawn from academia and potential markets-related roles with a background in economics. Now, Anthony, my first thought upon hearing all this was I know just the man for the board. He's very bright. He's in touch with the person in the suburbs. He's got a good feel for how markets and business works. And he's just retired as one of Australia's most preeminent business columnists. Surely, Anthony, Tony Boyd, former Chook, he'd be perfect.
Oh, absolutely. He'd be perfect. I'm all for it. Tony, put in your resume.
Exactly. Now, seriously, Anthony, I'm not sure how we'll obviously keep campaigning for Tony to make the RBA board, but is there any danger with these 6 experts coming in that we're going to have too many cooks in the kitchen here, that setting monetary policy is going to become even more convoluted than it is now?
Oh, for sure. I mean, I went back over that 294-page report this morning just to sort of have another read for it and make sure we sort of got the vibe right. And it's all about just getting more voices in there, more rigorous debate around the boardroom table. But it's all well and good to have more voices, more information, more sources of information. But that doesn't mean you're going to get the decision right at the end of the day, right? One of the hardest things about boards is, particularly as they get bigger, is getting the right people on there and the right mix, and then everyone being able to have the say that they need. So there's clearly taking power away from the governor, the deputy governor, and the sort of RBA, and making sure that there's other people heavily involved in that rates decision.
Yeah, I guess the counterpoint to that, though, Anthony, is that your analogy with the board is a corporate board's a good one. The danger on a corporate board, though, has long been sort of groupthink and a lack of challenge, and this has been something, an accusation levelled against the RBA. Phil Lowe's a great example, right? He's never worked anywhere else other than the RBA, and there's a lot of people in the RBA who are in a similar boat. They sort of institutionalised, and that can be a good thing and a bad thing. So more voices, but if those voices are sort of challenging and debating, there's something in that, surely. Oh,
for sure. And at the end of the day, you have to remember that the RBA is a big, expensive and important research institution, right? So there's a lot of knowledge within the RBA that their staff have. So you're having more directors, more people on the board, them spending more time with the RBA staff, so sharing that information, all the RBA sort of data and analysis has got to be a good thing. But it all boils down to just getting the right people on the board, and who those are, given the demands that these jobs going to require, it's going to be tricky.
Yeah.
The other part of the review that was quite prominent is the plan for the RBA to have fewer rates decisions each year. There's going to be 8, not 11. and there's a press conference after each one. I mean, do you think this more communication, fewer meetings is a good strategy, James, or is it going to be hard for them to stay on message?
It's a tough one. Chris Richardson, the economist, had a good line yesterday, I thought, and that's that Australia's never had more debt, so it's never been more important for us to all understand where interest rates are going. And so I guess the flow-on effect of that is more transparency, more communication is good. So, tick there. The one thing, I love getting up early and watching Jerome Powell, the Federal Reserve Chairman's press conferences after a rates decision, because the one thing that happens is they put out the statement and it's very, strident and clear and carefully worded. And then Jerome Powell gets up and he almost always inevitably muddles the message just a little bit because, he doesn't want to sound too grumpy or he doesn't want to sound too harsh. He softens things a little bit. There's a bit of slippage. And so I think it's interesting, this idea that you would have 8 chances for the governor or whoever faces the music to sort of muddle the message a little bit.
Yeah.
Given the fact that all of this review has been brought on by the RBA governor's poor messaging, that call that interest rates would stay on hold until 2024 when it turned out to be completely wrong. But is this 8 opportunities for the RBA governor to say something else that they might regret later? So that'd be my question.
Yeah. I mean, the other thing they want to see is the external appointments to the board do an address to the public as well. So one each per year.
Yeah.
So, you can only imagine the workshopping that'll go into those addresses.
Yes, but this is a big thing with the Fed too. There's so many Fed governors that you can often have a week where you've got 10 people from the Fed speaking, and they're all saying broadly similar things but slightly different, and so it gives the market a chance to, seize upon one sort of comment slightly out of context from someone and get all excited about that. So this could be a bit of a be careful what you wish for situation here. You end up with too much communication that the message, that's staying on message becomes a little bit tougher. And I thought there was something really interesting in your column, and that was your point that for the market, for investors, yes, these RBA changes are interesting, but the bigger deal is the budget on May 9. And of course, this is all leading up to the budget on May 9. Have you got a bit of a sense of what we should expect here?
Oh, it's a huge budget for the government. So Jim Chalmers needs to get this right. So that sort of sets them up for the next 2 or 3 years. And it's a really interesting time to be coming out with a budget because there's this cost of living sort of pressures where it's really tempting to go out and spend more money. But inflation's at 7 or 7.8%, and it's not really the time to be throwing cash around either. Australia's already got plenty of debt. There's not really any desire, I don't think, amongst the public to go out and spend heaps more debt. So if you're going to be throwing money around, you've got to find it from somewhere. We've already seen that he's prepared to go after a few sort of pockets out there, maybe some big super balances and the energy companies. But, so there's plenty in the mix for this budget. It feels like he's going to have to do some really hard work though, so that next year he can front up and say, all right, I did the hard work, and then the year after that will be the election.
Yeah. I think that's a good way of thinking about it, that this is a sort of long-term strategy of budget maintenance, and it's been interesting watching from afar. We're a week and a half out from the budget, but you can see these 2 weeks are going to be a lot of the budget's going to be sort of pre-announced, or the areas that he wants to go, that Chalmers wants to go to, have been pre-announced. We saw this week with the NDIS and EVs, and I think next week we're going to see more on defence and immigration. So he's telling this story, and I think there's something to be said for that Chalmers is trying to have a sort of broader conversation in a sort of rational way. That I think that's good. I mean, it's good that people understand the pressures on the budget and that it's not a bottomless pot of money that can be spent everywhere. But you're right, he does have relatively little room to move. The cost of living pressures on one side. He doesn't want to spend and be accused of adding to inflationary pressures. And he's still got some election work to do. So it's going to be fascinating. May 9, I'll be representing the Chanticleer team in Canberra, and should be plenty to talk about.
Just lastly on Lowe, though, what do you think? Do you think he should get a second term?
Oh, I think it's unlikely. Should he? I think it'd be good if there's a new voice. I mean, new sort of renovated RBA, new era. I think it would be good if there's a new voice, and I think he's unlikely to be offered a second term. I think Chalmers wants reform, whether this review means major reform or tweaking around the edges. Having a new governor would certainly put his stamp on it. What about you?
Well, if I had a 294-page report into my job performance and it came out with some of the 51 recommendations, I assume I'd be gone. But yeah, I'm still not convinced that there's someone better out there.
Yeah, fair enough.
So
fair enough.
We'll see. Well, it was a big week for Phil Lowe, but it was an even bigger week for Rupert Murdoch. On Tuesday night, we got news that Murdoch's Fox Corporation had settled its defamation lawsuit with electronic voting company Dominion for a staggering US $787.5 million, which is 1.2 billion Aussie. Now, Fox's on-air personalities had falsely claimed Dominion had rigged votes in the 2020 election. Now, James, what do you think the settlement achieved?
Well, I think, Anthony, for a start, it's stopped the rot for Rupert and Lachlan Murdoch. I mean, there was the potential that they were going to have to appear in a court case against Dominion for a start, which would have been extremely embarrassing because we've seen the text messages and other documents that were that came out in discovery as part of this lawsuit, and none of it was particularly flattering. I mean, it clearly showed that the Fox's on-air's personalities knew that they were pushing the boat out on these claims, and so this is that wouldn't have been good to go over in sort of intimate detail in court. I think it's probably also a reasonably good financial result for Fox. Actually, I mean, it's a lot of money to pay out. I get that. Certainly embarrassing, but you got to remember Dominion was after more than double what it eventually settled for. So Fox has got out of it on the cheap, you might say, given how open and shut this looked like a case. And I think I saw an estimate that this is about a half year of profits for Fox. So no one likes that sort of hit, but it's probably not a mortal wound. What's interesting to me is it's the second embarrassing back down in a few months. The Murdochs abandoned a plan earlier this year to unify Fox and News Corp. Now, that was dropped after investors just said, no, thank you, we're not going to get behind that. So you wonder if there's a few sort of cracks in the empire, I guess. And you know, there's, as we well know, there's a lot of succession issues at play here. There's a lot going on for the Murdochs. I did want to ask you, Anthony, you found a great little link. Obviously, Murdoch's the big loser here, but tell us about the winners. And there's an Australian link to Dominion and the company behind it.
Yeah, it was another sort of astonishing part of this whole astonishing story. So Dominion Voting's mostly owned by a private equity firm called Staple Street Capital, which is based in New York, and it's what they call a mid-market investor, which is basically a polite way of saying it does small deals. Staple Street owns 76% of Dominion. It bought that stake in 2018. It's done pretty well on the investment from all reports. Like in the documents that came out, that it was probably worth a couple of times what Staple Street had paid for it. Yep. And now that it looks like they're going to get this $1.2 billion injection, less taxes and legal fees and whatnot. So it looks like it's going to be a pretty good winner for Staple Street and Staple Street's investors. Now, the investors include, you know, big pension funds, usual sort of private equity types.
Yep.
But there's also an ASX-listed company that's sitting amongst the investors. And that's a little private equity investment vehicle called CD Private Equity Fund 2, which is listed on the ASX and trades under the code CD2.
Right.
Now, purely by luck, this CD fund, which is managed by E&P, the old Evans and Partners.
Okay.
It tipped into that Staple Street fund that made the Dominion investment. It cut a check to that fund probably about 8 years ago. And it put US $8 million into that Staple Street fund and said, Staple Street, do your best.
Right.
And then, you know, fast forward 8 years, there's this CD fund that's got now all of a sudden has a stake in Dominion Voting, and it looks like it's got a 10 or a 20 bagger on its hands.
Have we got a sense from CD what the size of their potential windfall is?
Well, CD was a bit slow to recognise this, and sort of we wrote about it on Wednesday night, and then they came out yesterday and confirmed that, yeah, it's all on track. They said be careful because the legal fees and the tax, is likely to take a fair chunk of it.
Yeah.
But I don't know. You'd have to think it's probably, it's going to turn $1 million into 10 or something like that.
Yep. Not a bad little help for a little ASX firm. What's interesting here also, Anthony, is that Fox and the Murdochs are facing a second defamation case from another electronic voting company called Smartmatic. Now, Dominion wanted some $1.6 billion US. Smartmatic wants $2.7 billion US in damages. So if you're inside Fox, perhaps a legal advisor, Anthony, what are you advising? Are you saying, let's settle this one as well, or do you fight a little bit further?
Well, history says it'll be fight, settle. That's the way it looks like they go, right? You fight all the way up to you can't fight anymore before hitting the witness box, and then you settle. I think all involved in that second case came out and said, look, it's a bit early to read too much into it, but I don't know. What do you think?
Oh, well, I saw something from the Smartmatic CEO today who said, we won't be going soft on either the damages or the apology that we want, because the Dominion apology ended up being pretty watered down. So he's talking tough, and I guess he's got the wind at his back given this settlement this week. So let's wait and see. All right, Anthony. Well, we're going to come back after the break and look at the next big bit of data for the RBA to watch, and that's CPI, which comes out next Wednesday. All right, Anthony. Well, we've got another big week coming up. We get over Anzac Day on Tuesday, and then we start to get into a bit more action around the economy and markets. And we start on Wednesday with the Consumer Price Index, so the official inflation numbers. The headline number last quarter was 7.8%. Economists are expecting 6.8% this time. What are you thinking here? This is sort of the last big bit of data that the RBA will see before their rate decision in the first week of May.
Yeah, this is the biggest quarter, economic release of the quarter. Clearly comes ahead of the next meeting. It's going to be well above the RBA's 2 to 3% mandated range. Yeah. So whether it's 6.8, 7, 7.5, 6.5, doesn't really matter. It's going to be too high. Yep.
Although, geez, I think if it had a 7 in front of it, that would be quite a moment for the economy or for economists, because really we had the RBA pause last month. If they don't have some significant movement in inflation in the right direction, that pause is going to look a little bit odd, I would have thought. But look, let's see. I mean, again, I guess this goes back to the fact that we do 11 rate decisions every month. Perhaps when we move to 8, which will be about every 6 weeks, that'll give the RBA a little bit more time to mull over these things, right?
Yeah, for sure.
And then on Thursday, Anthony, we've got our Alpha Live event at the AFR, and this is going to be a fantastic look across the market. We've got lots of great investors who are joining us. We're both hosting a panel. Who are you chatting to?
Yeah, I've got a couple of really interesting investors. There's Tanya Brandwhite from T Corp and Alicia Gregory at the Future Fund, who are going to talk us through the asset allocation at their big investment groups. And from the pre-calls that I've done, I'm really, really feeling like this is going to be a good panel.
Yeah, that's good. These are some of the smartest people in the market, so that's going to be good. I'm talking to a guy called James Montier of Boston-based GMO, which is the firm started by Jeremy Grantham, the sort of perma bear. James looks like a very colourful character. I'm chatting to him tonight ahead of our discussion. He's an expert on behavioural investing, and of course GMO is deeply contrarian, so I'm really looking forward to seeing what he's got to say about markets and where we're heading. Anthony, another one, we're in quarterly reporting season. Now, most of these are mining companies. We've had a few this week and a few more next week.
Yeah, there's a few coming up. So we had Rio and BHP this week. Next week's includes Fortescue on Monday and South32 on Monday as well. Mineral Resources on Thursday, IGO Friday. But yeah, it's just that time of the year. They tell us what they've done in the past 3 months, and then all those numbers go through to the actual forecasts.
Yeah, watch. Rio and BHP have both said some reasonably positive things about China in the last couple of days. So we'll watch Fortescue's numbers on Monday for any, and South32 for any further updates on that. All right, Anthony, put you on the spot. What are you feeling about the next rate move ahead of our inflation data this Wednesday? You think the pause is over? Will the RBA be hiking again?
I think the pause is over. Obviously, a lot will depend on that CPI number, but Philip Lowe made it pretty clear in his National Press Club address 2 weeks ago that the pause was temporary. It was very much just to sit back after 10 straight rate rises, just to double check what was going on. So it feels to me like there's another one coming. What about you?
Yeah, I'm with you. I think the pause is over. I think they've got a hike. The labour market's still very strong. I don't see any massive deterioration in economic activity or consumer spending. So, and as you say, inflation, even at 6.8%, if that's where it comes in, geez, that's a long way from 2 to 3%, which is the RBA's target range. All right, Anthony, well, we love getting questions from our audience, and this week our question is from Michael Francis from Toowoomba. If you have a question that you want to send in, you can email us at chanticleer@afr.com, but you can also send us a question in audio form. All you've got to do is record a voice memo on your phone, include your first name and where you're from, and email us at chanticleer@afr.com. We're looking forward to our first audio question, so you can be the pioneer. Get your questions in this week. Anthony, I'm going to hand this one over to you to ask the question from Michael.
Yeah, so Michael asks, he says, I'm not sure if the subject above warrants a question, but I do enjoy Howard Marks' memos and pricked my ears to the end of last night's about potential problems for banks and commercial real estate. I'm wondering what your thoughts might be for our banks and commercial real estate here in Australia. And then he said, I can't help but comment, it's interesting that the new boss, i.e. you, James, headed off for a couple of weeks' holidays and leave the young bloke, myself, in the top job.
Well, look, and what a sterling job you did. So, Michael, I think my judgment has been vindicated there to throw Anthony in the deep end, and he's started in the last couple of weeks. This was an interesting memo from Howard Marks on the Silicon Valley Bank collapse and various things. I guess Howard Marks' main point was that he didn't see the Silicon Valley bank collapse as a sort of systemic moment. But he did talk about the problems in commercial real estate where US banks, particularly the smaller ones, are heavily exposed to this asset class, which is a worry given particularly in offices where work from home is still prevalent and office valuations are falling. The concern is that the banks get caught with some bad loans. The Australian banks got caught with really bad commercial property exposures in the 1990s, and it is seared into their memories. So their commercial property exposures are relatively small, and they feel pretty good about their exposure to the office market. Now, the one caveat here, Anthony, is that we spoke to one of the leading bankers a couple of weeks ago, and he did make the point that every bank thinks that their own book's in pretty good shape. But if there is some sort of major problem in commercial real estate, it will flow through in other ways. So you'll see the tradies who work on these building sites, the subcontractors, the building contractors, the various service providers, they'll all be hit, and some of that will flow through to the bank's bad loans. But I think our banks have been really careful around this stuff and are in a much better position than the regional banks in the US particularly. So everyone's watching this. It's not going to be a surprise if it goes pear-shaped. But at the moment, Australia looks to be pretty well insulated from that. All right, Anthony, before we sign off, I just wanted to check in with you. A recommendation for this week. I was thinking of spending a little time watching the Rebel Live golf tournament, which comes to Australia this weekend. It's in South Australia, kicking off on Friday and on Saturday and Sunday. Now, I'm a bit not so excited about the Live Tour. I'm a bit of a traditionalist, and what do you think? Is this one, as a golf fan, you're excited about, or something to dodge?
Well, once I've mown the lawn, if it's raining, there's absolutely nothing else on this weekend. Maybe I'll tune in. But I love my golf. I'm every Sunday, Monday morning watching the US PGA. But but the Live I haven't tuned in yet, and even though it's been played in Australia, I don't think it will. So I'll probably dodge it.
Yeah, fair enough. Fair enough. All right. Well, have a great weekend, Anthony, and thanks for joining us again today.
You too, James.
And we wish all our listeners a great weekend. We'll catch you next week. Well, if you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson and Anthony Macdonald. The producers are Lap Fan and Alex Gow. Our theme music is by Alex Gow. See you next week.
The Australian Financial Review.